In the aftermath of the Silicon Valley Bank crisis, we've entered a really interesting state, which is that the Fed is simultaneously injecting cash into the system and pulling cash out of the system. In this video, I want to explain why that's happening and show you the data. First, a brief review of how money is created in our financial system. There are three kinds of institutions in our financial system. There's the Fed, which is the only agency that's able to create cash. There are banks, which are the agencies that can create deposits. And then there's everybody else. New cash enters the system in one of two ways. The Fed can generate new cash and lend it to the banks. This increases the amount of cash held at the banks. And if these loans are repaid, that reverses the process. A second way in which cash can be created is if the Fed goes out and buys assets. So for example, the Fed might choose to buy treasury bonds. And if the Fed decides to sell assets, that reverses this process and reduces the amount of cash that's out there. A second kind of financial instrument is deposits. These are the kind of money that's held in your bank accounts. Deposits can be created when people go and deposit their cash at the bank. That will both increase the amount of cash held at the bank and increase the deposits held at the bank. But deposits can also be created in a second way. They can be created when someone borrows money from the bank. This increases the amount of deposits but does not change the amount of cash. And when the loan is repaid, this process is reversed. In fact, most money was created by the banks during the process of lending. You can see that by plotting the amount of deposits that are out there and comparing it to the amount of cash held by banks. Now, almost all problems can be solved by creating more money, except for one problem, and that's the problem of inflation. And we are experiencing that problem right now. The Fed is trying to deal with this problem by reducing the amount of money that's out there. They're doing it by raising interest rates to make it harder for banks to borrow money, and also by selling assets to directly pull out cash from the system. And that's been the plan over the last year. They've been trying to reduce their assets and increase interest rates at the same time. Both of these choices were made to reduce the amount of money that's out there. The problem is that if the Fed takes out too much cash, then it can cause crises because the banks, for example, might not have enough cash to support the transactions that their customers want to have. But after the Silicon Valley Bank crisis, something very interesting happened. The Fed had to inject a massive amount of cash in a very short amount of time to support the banks, to make sure that the crisis did not spread to all other banks. The effect is that shortly after the crisis, the amount of assets held by the Fed was comparable to the amount of assets held at about October of last year. And since then, the Fed has gone back down to reducing the amount of assets it's holding. So that is the state we're in, and this is why I think it's a very interesting time. It will be very interesting to see what happens when this number drops down to be substantially lower than the state that the system is used to.